There is a quiet machine moving through the markets right now, and most people do not see it because they are looking in the wrong place. They are watching the same index every morning. They are watching the same big technology names. They are watching the same headlines, the same price moves, the same crowded trades, and they believe they are observing the market, but very often they are not observing the market. They are observing the part of the market that has already become obvious. The real movement usually begins somewhere else. It begins in the flow of capital before it becomes a headline. It begins when large pools of money start leaving the places everybody loves and start entering the places almost nobody is paying attention to. That is the quiet machine. It does not announce itself loudly. It does not ask for permission. It does not care whether retail investors understand it. It simply moves capital from one part of the system to another. And when it does that, it often makes the people who understand the process richer, while leaving everyone else wondering why the market they bought is not behaving the way they expected. Right now, money is rotating out of some of the sectors that have received the most attention and into areas that many ordinary investors have barely studied. If you miss that rotation, you can spend the next year watching the broad index move sideways while a smaller group of stocks moves powerfully because the capital flows have changed underneath the surface. If you catch the rotation, you give yourself a chance to participate in a more intelligent way. Not by gambling, not by chasing meme stocks, not by pretending you know the future, but by studying how money moves through the system and by building a disciplined process around that movement. That is the difference between reacting to headlines and following cause and effect. Most investors begin with the wrong question. They ask, what stock should I buy? That question feels practical, but it is usually too narrow and too late. The better question is, where is capital moving and why? When you understand that individual stocks become the final step, not the first step. So I want to walk you through the way I think about this. I want to show you why the biggest stocks keep getting bigger, why the index structure itself channels money toward them, why that can become both powerful and dangerous, and how I think about finding sectors that are beginning to attract capital before the crowd fully understands what is happening. The basic picture is not complicated if you look at it like a system. I think of the market and the economy like weather. Weather is always changing. Sometimes there is sunshine, sometimes there are clouds, sometimes there is a storm. Sometimes the storm has not arrived yet, but the pressure in the air is already shifting. Your job as an investor is not to predict every raindrop. That is impossible. It is not even the right objective. Your job is to look at the weather that exists, understand the conditions you are actually operating in, and dress for that environment. That sounds simple, but most people do not do it. They dress for the last season. In 2021, the weather was very different. Money was abundant. Liquidity was everywhere. Many assets went up together. A person could buy almost anything and feel intelligent because the environment made almost everyone look intelligent. That is not the same world we are in now. Now investors are dealing with inflation pressure, uncertainty around interest rates, governments that appear willing to use the printing press again when stress rises, central banks that have to balance growth and inflation, wars, energy insecurity, oil shocks, supply chains, minerals, defense spending, and the enormous power demand created by artificial intelligence. All of those things are connected. They may look separate on the surface, but in a system they interact. One pressure creates another pressure. One shortage creates new investment somewhere else. One geopolitical risk forces a government or a company to change its behavior. One cycle leads into the next. That is why what you own can matter more than the simple fact that you are invested. In some environments, buying the broad index can work well because liquidity lifts many parts of the system at the same time. In other environments, the market becomes much more selective. Some sectors receive capital, others lose it. Some assets become crowded, others become ignored. Some companies benefit from the new conditions while others sit still because the money has moved away from them. When the weather changes, different parts of the market need different clothing. This is the first idea most people miss. They think the market is one thing. It is not one thing. It is a collection of different pieces. Capital moves across those pieces. It rotates, it gets crowded, it leaves, it searches for relative advantage, it responds to inflation, policy, shortages, demand, fear, and opportunity. If you only look at the index, you can miss the most important movement happening underneath the index. The index itself has become part of the machine. Most people know the S&P 500 as a simple basket of the 500 largest public companies in America. They believe that if they buy the S&P 500, they are spreading money equally across American business. That is not what is really happening. The S&P 500 is weighted by market capitalization. That means the bigger the company becomes, the larger its weight in the index. The larger its weight in the index, the more passive money flows into it whenever people buy the index. The more passive money flows into it, the more support the stock receives. And as the stock goes up, it becomes an even larger portion of the index. That is a feedback loop. Feedback loops are powerful in markets. They can continue for a long time. But they can also create hidden concentration risk that many investors do not understand. If one very large company is 10 times the size of a smaller company inside the index, the passive investor is not putting the same amount of money into both. The passive investor is putting far more into the large company simply because the index says so. That means pension money, retirement money, 401k money, ETF money, and other passive flows constantly channel more capital toward the largest companies. It happens automatically. It happens without anyone making a new judgment each day. It happens because the structure is built that way. At the moment described in the source material, the top 10 companies make up roughly 40% of the index, while the other 490 companies make up the remaining 60%. That level of concentration is unusual and important because it means that buying the market is not as diversified as many people assume. You may think you own 500 companies. In practice, your results can be dominated by a very small group of mega-cap stocks. When those mega-caps are winning, the system feels wonderful. Microsoft, Amazon, Nvidia, and the other largest names pull the index higher. Passive investors feel smart, the flywheel works in their favor. But when those leaders stop leading, the same structure becomes a problem. The index can stop moving. It can chop sideways. It can look healthy on the surface while the real opportunities have shifted elsewhere. And because so much money is crowded into the same names, the downside can also become faster when the feedback loop turns the other way. This does not mean that owning the index is wrong. It means you should know what you actually own. That is a principle. Never own something because the label sounds safe. Understand the mechanism underneath the label. A broad index fund can be a good tool. A concentrated megacap vehicle can also be a deliberate tool if someone wants that exposure. But not understanding the concentration is dangerous. The problem is not the tool. The problem is unconscious exposure. Many sophisticated investors understand this. They do not just ask whether the market is up or down. They ask which parts of the market are receiving money, which parts are losing it, and which parts are beginning to improve while most people are still looking backward. That is where sector rotation becomes important. A common retail investor wakes up, checks the news, checks the S&P 500, looks at the same huge stocks everyone else is looking at, and asks, what is moving today? That is a reactive process. Large capital often operates differently. It does not sit forever in the same place. It rotates from crowded sectors to less crowded sectors, from expensive areas to cheaper areas, from popular trades to unloved trades, from technology to energy, from mega caps to smaller industry groups. From growth excitement to infrastructure necessity, the educated money is not always smarter in the sense of knowing the future, but it often has better training, better process, and better tools for watching flows. Your job is not to guess which famous stock will win every month. Your job is to understand the flow of money and to see where it is moving before it becomes so obvious that everyone is talking about it. Mainstream media usually tells people about a move after the move has already matured. By then, the easy money has often been made. The risk-reward has changed, the narrative has become popular. And when a narrative becomes popular, it is no longer the same opportunity, so the process has to begin earlier. I think about it in a very simple sequence. I first ask what the macro weather is. I do not try to become a prophet. I do not need to predict everything. I need to understand the major forces. Are we in an inflationary environment? Are rates staying higher than the crowd hoped? Is energy becoming more important? Are minerals becoming scarce? Is defense spending increasing? Is AI creating new demand for power and infrastructure? Are governments trying to secure domestic supply chains? That is the weather report. Then I ask which sectors are filling with capital because of that weather. I do not choose blindly. I rank the areas by money flow and by the strength of the tailwind. I want to know where the pressure in the system is forcing capital to go. Only after that do I look for leaders inside the winning sectors. That order matters. Most people start with stocks. I prefer to start with conditions, then sectors, then companies. If you reverse that order, you can fall in love with a stock that is sitting in the wrong part of the weather. A good company in a bad money flow environment can disappoint you. A less famous company in a strong capital flow environment can surprise you. That is not magic, that is cause and effect. The first sector that stands out in the source structure is oil and gas machinery, equipment, and services. To understand why, think about a gold rush. During a gold rush, the people who become rich are not always the miners. Sometimes the better business is selling the picks, shovels, equipment, transportation, and infrastructure that all the miners need. In oil and gas, there is a similar structure. There are companies that produce oil and gas, and then there are companies that provide the machinery, drilling equipment, compressors, tools, maintenance, pipelines, terminals, and infrastructure that make the production possible. Those companies are the picks and shovels of the energy system. When the world needs more energy, those companies can benefit even if the investor does not want to make a pure bet on the commodity itself. When energy infrastructure has to be built, maintained, repaired, expanded, or secured, the machinery and service providers can become very important. Why is the world likely to need more of that? Energy demand is not going away. Artificial intelligence consumes enormous amounts of power. Data centers need electricity, cooling, backup systems, and reliable grids. LNG demand is rising because natural gas can be transported globally and used as a bridge fuel in many countries. Pipelines, terminals, export facilities, compressors, and related equipment are needed for that system to function. Geopolitical risk also changes behavior. When critical energy routes become unstable, countries begin thinking differently about storage, domestic production, alternate routes, and infrastructure redundancy. If a major choke point becomes risky, governments and corporations do not simply hope for the best. They build resilience, they spend money, that spending flows somewhere. In this case, the flow can benefit the machinery and infrastructure companies tied to oil, gas, and LNG. These are not always the companies retail investors talk about at dinner, but they can become important when the weather changes. One company on the watch list is Baker Hughes, ticker BKR. The reason it fits the framework is straightforward. It is one of the large global oilfield service and energy technology companies. It sells tools, systems, and services that help energy infrastructure function. If the world has to drill more, build more LNG capacity, maintain more infrastructure, and respond to energy insecurity, a company like that sits near the flow of spending. The important point is not to treat the ticker as a tip. Tips are dangerous. A ticker without a process is not investing. It is just borrowed conviction. The process is to watch whether the company sits in the right sector, whether the sector is receiving capital, and whether the price action confirms that institutions are participating in the source chart discussion. The interesting pattern was a stock moving sideways and then beginning to push above prior highs. That matters because markets often move in pulses. They rise, pause, consolidate, test the same area, and then either fail or break out. I do not like to buy simply because something looks cheap. Cheap can become cheaper. I prefer to see evidence that demand is returning. That is why buying slightly above a prior high can make sense in a disciplined process. To many people, that sounds insane. They ask, why would I pay more tomorrow when I can pay less today? The answer is probability. When a stock breaks above a zone that previously stopped it, it may be signaling that supply has been absorbed and demand has become stronger. You are not paying more because you enjoy paying more. You are paying for confirmation. You are paying after the market shows you that the balance of pressure may have changed. That does not guarantee success. Nothing does. But investing is not about guarantees. It is about probabilities, risk, and process. Another company mentioned in that energy infrastructure area is NPK, a smaller player connected to temporary worksite infrastructure for energy and construction projects. Smaller companies can move more sharply both up and down. They can benefit when the sector tailwind is strong, but they also require more careful sizing because the risk can be higher. The point again is not to blindly buy it. The point is to recognize that when capital moves into a sector, the leaders and related suppliers in that sector can become part of the opportunity set. In the source structure, the stock had already moved significantly over the prior year, yet the argument was that a move is not automatically over because it has already moved. This is another mistake many people make. They assume a stock that has gone up is too late and a stock that has gone down is cheap. That is not a principle, it is a habit. A rising stock in a strengthening sector can keep rising if the money flow continues. A falling stock in a weakening sector can keep falling even if it looks cheap on a simple price chart. That is why the chart pattern matters. Sideways movement after a strong move can be a resting phase. If the stock breaks above the recent highs with volume, it may show that the next wave of demand is arriving. Again, this does not eliminate risk, it organizes risk. I think that is one of the great differences between professionals and amateurs. Professionals do not avoid risk, they define it, size it, and test it against evidence. The second major area in the source structure is mining, critical minerals, uranium, lithium, rare earths, and related non-metallic minerals. That may sound less exciting than artificial intelligence or software, but systems do not run on excitement, they run on inputs. The modern world is becoming more electric. Electric vehicles require minerals, batteries require minerals, solar and wind require minerals. And because the sun does not shine at night and the wind does not blow on command, renewable systems require storage. Storage requires minerals. The grid needs modernization, and grid modernization requires materials, equipment, and supply chains. Artificial intelligence data centers require vast amounts of power and cooling. Defense applications require specialized materials. Governments do not want to depend on strategic rivals for the inputs that determine industrial security. When a resource becomes strategically important, it stops being just a commodity story. It becomes a national security story, an industrial policy story, and a capital flow story. That is why critical minerals matter. The source material described the U.S. government mobilizing large financing to develop domestic mineral supply chains. The exact number given was about $30 billion. Whether one focuses on that number or the broader direction, the logic is the same. Governments are trying to reduce dependency and secure supply. When governments, technology companies, energy companies, and defense priorities all point toward the same input shortage, investors should pay attention. One company on the list is SQM, Sociedad Química y Minera de Chile, a major lithium producer. Lithium sits at the center of battery demand. If the world needs more batteries for electric vehicles and storage, lithium supply becomes important. SQM has large-scale operations and is connected to Chile, one of the most important lithium geographies in the world. The source discussed its growth efforts, Australian operations, and partnership with Chile's state-owned mining company to increase capacity. Again, the stock itself is not the point in isolation. The point is the chain. The world needs more electrification. Electrification needs batteries. Batteries need lithium. Lithium supply is concentrated. Companies with scale and access can become important. Then the investor looks at whether money is starting to move into that part of the market and whether the chart confirms it. In the chart discussion, the pattern was sideways motion and a potential breakout above a previous high around 95.50 in the source example. The number itself is less important than the principle. The market had built a level. If price pushed above that level, it would suggest that buyers were willing to pay more than the prior ceiling. That is not a reason to become reckless. It is a reason to watch carefully. The next company mentioned is Uranium Energy Corp. Ticker UEC. Uranium is important because nuclear energy is moving back into the conversation. For years, many investors ignored nuclear. Some countries shut plants down, some treated it as politically impossible. But when power demand rises, when grids become stressed, and when AI data centers require reliable baseload electricity, nuclear becomes harder to ignore. Uranium supply then becomes part of the energy security system. The source material discussed UEC starting production at a uranium mine in South Texas, describing it as the first new U.S. uranium production facility to come online in over a decade. It also described the company as having two active uranium mining operations, one in Wyoming and one in Texas, and the ability to process 4 million pounds of uranium per year. The logic is not complicated. If the United States wants domestic uranium supply and wants less dependence on adversarial or unreliable foreign sources, then domestic producers and processors can become more strategically valuable. But the chart in the source structure was not yet giving a full signal. The stock had rallied, fallen back, and then formed higher lows. That can be an early sign of reversal, but early is not the same as confirmed. This distinction matters. A watch list is not the same as a buy list. A watch list is a place where you observe the evidence. You are saying, if this system develops the way I think it may develop, this company could become important. But I still need confirmation. Patience is part of risk management. Another name mentioned is CMP, a minerals and rare earth related play. The source chart discussion suggested that it was near a possible breakout area and that a price around 27 would be more interesting because it would mean the stock had moved above the level that mattered. Again, the principle is not about memorizing a price. The principle is waiting for the market to prove something before committing capital. This runs against the instinct of many ordinary investors. They want to buy before anything moves because they want the lowest price. But wanting the lowest price often means buying before there is enough evidence. Sometimes that works. Often it creates unnecessary pain. I would rather miss the very bottom and participate in a higher probability move than buy early simply because a stock feels cheap. That is the discipline behind breakout investing when it is done properly. It is not chasing. Chasing is buying because of emotion. Confirmation is buying because the evidence changed. The key difference is process. Now, if you step back from the tickers, the larger message is more important than any single name. The stock market is not one giant switch that turns on and off. It is more like a chessboard with many squares. One square may be software, another may be uranium, another may be oil services, another may be gold miners, another may be healthcare, another may be construction, another may be insurance, another may be electronic components. Money moves across the board. When money leaves one square and enters another, prices respond. That is the mechanism. It does not require a complicated theory. It requires watching the flow. If the SP 500 is flat, that does not mean nothing is happening. It may mean the broad index is being held back by crowded leaders while capital is quietly accumulating in smaller or less popular sectors. It may mean one part of the market is falling and another part is rising. It may mean the real opportunity is underneath the surface. This is why people who only follow the headline index often feel confused. They hear the market is weak, but some stocks are rising sharply. They hear the market is strong, but their portfolio is not moving. They think the news is lying. Usually the problem is simpler. They are looking at the wrong level of the system. You have to look at the market as a system of flows. In one period, electronic components may receive money. In another period, defense stocks may receive money. Then mining stocks, then oil and gas services, then construction, then insurance. The rotation changes as the weather changes. The goal is not to marry a sector forever. The goal is to recognize when the flow is entering, participate with discipline, and exit when the flow begins to leave. That can mean holding a position for months. It can mean holding it for a year or two. It can also mean leaving much sooner if the evidence changes. The time frame should be driven by the behavior of capital, not by ego. This is where most people get into trouble. They turn an observation into an identity. They buy something, then they want to be right. They defend it. They explain it. They become emotionally attached to the story. Markets do not pay you for defending a story. Markets pay you for understanding reality better than your previous assumptions. If the money leaves, the principle is simple. You leave with it. This brings us to risk management. Nothing in this process works if risk is not controlled. A good thesis can still be wrong. A good sector can still reverse. A breakout can fail. A company can have bad news. A commodity price can turn. A government policy can change. A geopolitical event can move in the opposite direction. You do not control those things. You control position size. You control entry discipline. You control whether you average into something intelligently or dump a large amount of capital into an idea you barely understand. You control whether you define your risk before you enter in the source material. The risk rule was to build positions so that the maximum loss from a trade bucket is about 1%. That does not mean the position is 1% of the portfolio. It means the risk is sized so that if the trade is wrong, the damage is limited. That is an important distinction. Many investors think in terms of how much they can make. Professionals begin by asking how much they can lose if they are wrong. That is not pessimism. It is survival. In markets, survival comes before success. If you do not survive, you cannot compound. If you cannot compound, you are not investing, you are just taking chances. You can express a sector view through individual stocks, or you can use a fund or basket if you want broader exposure. Both approaches can be reasonable depending on skill, time, risk tolerance, and knowledge. Individual stocks can give more upside and more specific exposure, but they also require more work and more company-specific risk. Funds can reduce single-name risk, but they may dilute the exact thesis. There is no universal answer. There is only fit. The important thing is not to put a large amount of money into a new area you do not fully understand. Scale in. Learn the behavior of the sector, watch the flows, study the leaders, observe how the stocks respond to news, interest rates, commodity prices, and the broader market. An investor should be humble enough to let the market teach him. That is another principle. Do not confuse confidence with understanding. Confidence is easy to manufacture. Understanding comes from seeing the system, watching it over time, and recognizing the cause and effect relationships that repeat the cause. An effect relationship here is that macro weather changes capital allocation. Capital allocation changes sector leadership. Sector leadership changes stock behavior. Stock behavior gives the investor evidence. Evidence allows the investor to act with a defined risk, that is the chain. When people skip the chain, they end up chasing names. When they follow the chain, they begin to think like system observers. In the current environment described by the source, two areas deserve attention because they connect directly to the weather. One is energy infrastructure, especially oil and gas machinery services, LNG, and the equipment behind energy security. The other is critical minerals, lithium, uranium, rare earths, and the materials that support electrification, AI, power, demand, defense, batteries, and grid modernization. Those are not random themes, they are responses to structural pressures. Inflation pressure makes hard assets and infrastructure more relevant. Energy insecurity makes oil, gas, LNG, and related equipment more relevant. AI makes electricity and cooling more relevant. Electrification makes minerals more relevant. Geopolitical fragmentation makes domestic supply chains more relevant. Government financing makes strategic industries more relevant. That is how a macro observation becomes an investment watch list. The mistake is to stop at the story and never test the evidence. A beautiful macro story can still lose money if the capital is not actually flowing into the stocks. A sector can be logically important and still be a bad trade for a long time. That is why I do not stop at the narrative. I want to see the money. The money often shows up in relative strength, volume, breakouts, higher lows, and the way a stock behaves during weak market days. A sector that holds up when the market falls is telling you something. A stock that breaks above a long resistance area with strong participation is telling you something. A name that refuses to fall while the crowd ignores it may be telling you that stronger hands are accumulating. None of those signals is perfect, but together they improve the odds. Investing is not about certainty. It is about improving odds while limiting downside. That is why I care about rotation. If you are simply buying the same mega cap names after everyone has already crowded into them, you may still do fine if the flywheel continues. But if the market shifts, you can be late. If you understand the flywheel and also understand rotation, you have more choices. You can own the large winners when the money is still flowing there. You can reduce exposure when the evidence weakens. You can begin watching the sectors where the next flow may be building. You can avoid becoming trapped in yesterday's trade. That is a more adaptive way to invest. The market punishes people who insist that the future must look like the recent past. It rewards people who can observe change without ego. This is especially important now because the index concentration itself can hide the change. When 10 companies dominate the index, they can make the surface look stronger or weaker than the underlying market really is. They can distract investors from smaller industry groups where money is already moving. So an investor has to look beneath the surface, ask what the broad index is doing, but do not stop there. Ask what sectors are outperforming. Ask whether leadership is narrowing or broadening. Ask whether energy, minerals, defense, construction, healthcare, or other areas are gaining strength while the public is focused somewhere else. Ask whether institutions are accumulating in industries that retail investors rarely study. That is how you begin to see the quiet machine. And once you see it, you cannot unsee it. You realize that the market is constantly reallocating resources. You realize that news follows price more often than price follows news. You realize that the best opportunities often feel strange at first because they are not yet socially validated. You realize that many investors do not lack intelligence. They lack a process. A good process does not need to be complicated. Look at the weather, watch the sector flow, identify the leaders, wait for confirmation, size the risk, scale intelligently, leave when the evidence changes. That is not a prediction system, it is a decision system. There is a big difference. A prediction system tries to be right about the future. A decision system tries to make good choices under uncertainty. The second is much more useful because the future is always uncertain. When you look at oil and gas machinery, do not think, I know exactly what oil will do. Think, if energy demand, LNG build-out, geopolitical risk, and infrastructure spending continue, which companies may benefit, and is capital already confirming the thesis. When you look at critical minerals, do not think I know exactly what lithium or uranium will do next month. Think if electrification, AI power demand, defense needs, and domestic supply chain policy continue, which companies sit in the path of that demand, and is capital starting to recognize it. That is a probabilistic way to think. Ray Dalio principles always come back to reality, cause and effect, humility, and systems. You do not have to know everything, but you do have to know what you are testing. If the thesis is energy infrastructure, the evidence should show capital moving into energy infrastructure names. If the thesis is critical minerals, the evidence should show money moving into miners, processors, uranium producers, lithium producers, or related companies. If the evidence does not show it yet, you wait. Waiting is not weakness. Waiting is discipline. The worst mistake is to confuse urgency with opportunity. A real opportunity can be acted on calmly. If you feel forced, you are probably being pulled by emotion. That is why I prefer clear levels and clear risk. For Baker Hughes, the source pattern was a move above a prior high with signs of institutional volume. For NPK, the interest came from the combination of sector tailwinds, strong prior performance, and a consolidation that could become another move if confirmed. For SQM, the setup was tied to lithium capacity growth and a potential move above a previous high. For UEC, the setup was more watch list oriented because the trend had not fully confirmed. Even though the uranium story was powerful for CMP, the source suggested watching for a push above the relevant breakout area. Each name had a role in the same broader framework. Some were closer to confirmation, some were earlier, some were larger, some were smaller, some were tied to energy infrastructure, some were tied to minerals. The job is to know the difference. Retail investors often want a simple answer. Buy this, sell that, hold this forever. Markets are not that simple. A simple answer can be comforting, but comfort is not the objective. Good decisions are the objective. Good decisions require context. Context says the index is concentrated, passive flows have created a flywheel into the largest stocks. That flywheel can continue, but it also creates vulnerability. Meanwhile, capital is rotating under the surface. Macro weather is changing. Energy, minerals, AI, power demand, defense, and supply chain security are forcing money toward less obvious sectors. In those sectors, certain companies may become leaders if the price action confirms the flow. Risk has to be sized carefully because no thesis is guaranteed. That is the complete picture. If you understand that picture, you are already ahead of many people who are simply staring at the same 5 or 10 megacap stocks every day. But understanding is not enough. You have to build a routine. It does not need to consume your life. It may take an hour a week to review the sectors, compare relative strength, update watch lists, check whether the macro weather has changed, and decide whether any setup has moved from observation to action. Most people spend 40, 50, or 60 hours a week earning money, but they do not spend 1 hour managing how that money is allocated. That is a strange trade-off. The money you save and invest represents stored life energy. It deserves a process. If you do not have the skill set yet, build it. If you do not have the tools yet, start with the simplest version. Track the sectors, watch the leaders, look for capital flow study charts, not as pictures, but as evidence of supply and demand. Learn position sizing, learn when not to act. The market does not require you to be brilliant. It requires you to be less reactive and more principled than the crowd. That is all following the money really means. It means you stop treating every headline like a command. It means you stop assuming the index tells the whole story. It means you stop buying a stock just because someone said it could go up. It means you build a map of the system and then watch where capital moves on that map. When money enters a sector, prices tend to respond. When money leaves, prices tend to weaken. The art is not in saying that after everyone sees it. The art is in recognizing the shift early enough, but not so early that you are acting without confirmation. That balance is where process lives. So when I look at the current environment, I do not see a simple market. I see a market where owning the right thing matters much more than simply being invested. I see a market where the index is heavily influenced by a small group of giant companies. I see a market where the passive flywheel has rewarded those giants, but also made many investors more concentrated than they realize. I see a market where energy, infrastructure, and critical minerals are becoming more important because the world is reorganizing around power security, supply chains, and hard inputs. And I see a market where investors who understand rotation may have an advantage over those who only follow the obvious names. That does not mean you rush, it means you prepare. Preparation means knowing the sectors before they become popular. It means knowing the watch list names before the breakout. It means knowing your risk before the entry. It means knowing your exit before emotion takes over. It means having the humility to say, if the evidence changes, I will change. That is one of the most important principles in investing and in life. Reality is always sending signals. Most people only listen when reality shouts. Good decision makers listen when it whispers. Right now, the whisper is that capital is rotating. The whisper is that the broad index may not tell the whole story. The whisper is that the world needs energy, infrastructure, minerals, uranium, lithium, LNG power, and domestic supply chains, more than most retail investors have priced into their thinking. The whisper is also that the market is more dangerous when people believe it is simple. If you think buying the index means you are equally diversified, you are missing the structure. If you think the biggest stocks can lead forever simply because they have led recently, you are missing the cycle. If you think a sector is boring because it is not on social media, you may be missing where the capital is actually going. That is why the framework matters more than the stock list. The stock list can change, the weather can change, the leaders can change, the levels can change, but the process remains useful. Look at the world, identify the pressures, follow the money, study the sectors, choose the leaders, wait for confirmation, control the risk, stay humble. If you do that, you do not need to be the smartest person in the market. You only need to stop behaving like the most distracted person in the market. Most people are distracted by what is loud. Money is usually made by studying what is quietly becoming inevitable. That is the real lesson. The biggest opportunities of the next period may not come from the stocks everyone already agrees on. They may come from the machinery behind energy, the infrastructure behind LNG, the minerals behind electrification, the uranium behind nuclear power, and the companies that sit at the intersection of necessity and capital flow. Those areas may still be unfamiliar to many investors. That is exactly why they are worth studying, not buying blindly, studying, because when a sector goes from ignored to necessary, the repricing can be powerful. And when that repricing begins, while most people are still focused on the old leaders, the investor with a process has a chance to see something the crowd does not. The market is not rigged in the sense that you cannot win. It is structured in ways most people do not understand. Passive flows favor the biggest companies. Headlines favor the obvious stories. Human nature favors what recently worked. Institutions rotate capital before the public narrative catches up. Once you understand those forces, you stop taking the market personally. You begin to see it as a machine, and if you can see the machine, you can make better decisions inside it. That does not mean every decision will work. It means your decisions will come from a principle instead of an impulse. In the long run, that difference matters enormously. So the next time you open the market and see the S&P 500 doing very little, do not assume nothing is happening. Ask where the money is moving. Ask which sectors are gaining strength. Ask whether the biggest index names are hiding a rotation underneath. Ask whether energy machinery, critical minerals, uranium, lithium, or rare earths are receiving capital because the world itself is changing. Then ask whether the specific companies on your watch list are confirming the thesis. If they are not, wait. If they are, act carefully. And if the evidence changes, change with it. That is how I think about markets, not as a place to prove I am right, but as a system to understand, navigate, and respect. The rich often get richer not because they know a secret stock, but because they understand flows, structure, and risk. They know money moves in cycles. They know concentration can become fragile. They know unpopular sectors can become powerful when the environment changes. They know the goal is not to predict perfectly, but to be prepared when probability shifts. Most retail investors are not doomed. They are simply late because they are looking where everyone else is looking. You do not need to do that. You can watch the weather, you can follow the money, you can study the sectors, you can wait for the leaders, you can manage the downside, you can stop chasing excitement and start observing cause and effect. That is not a guarantee of wealth, but it is a much better way to play the game. And in a market where the next rotation may matter more than the last headline, that may be the difference between watching the opportunity from the outside and recognizing it while there is still time to act with discipline.